Are you considering purchasing an annuity? If you are, then you'll want to be aware of the 5 questions that annuity owners should consider before they surrender an annuity. When someone surrenders an annuity, they are canceling their contract. And there are a lot of different considerations that go into canceling a contract. So before you purchase an annuity, know what it looks like at the back end so that you can make a strong financial decision for your future. Hi, I'm Nathan Garcia. I'm a certified financial planner and retirement planning specialist. I've been in the financial services industry for over 10 years, and over that time, I've had a lot of people ask me if an annuity is right for them. I've also helped a lot of clients with making a decision whether to surrender an annuity or not. And over that time, I have come across a lot of questions that are very common but very helpful for you if you're considering purchasing an annuity. Now, of course, this isn't financial advice for you, and make sure that you consult with a professional before taking action on anything that you see or hear here. I'm also not making a pitch for any security or an annuity. Make sure that you consult with a licensed representative who can help you before taking action on anything you see here. That out of the way, let's look at the 5 questions to consider before surrendering an annuity. The first one is, what are the total fees associated with the contract itself? Now, an annuity can come in many different forms. It could be an immediate annuity. You could be talking about a deferred annuity, a variable annuity, an index annuity, and each state regulates their insurance industry a little bit differently. And so each state is going to have separate contracts. So before you surrender an annuity, you want to look at the total costs associated with your contract. These will be mortality and expense charges. They'll also include any rider expenses if you have them, and they could include sub-account fees for any underlying investments. Once you total up all of those individual costs, you'll be able to get a clear definition of how much that contract is costing you and what you're paying for. The fourth question to consider before surrendering an annuity is there a lifetime income benefit available? A lot of people purchase annuities because of the guaranteed lifetime income. And when you give up an annuity, you may be giving up that lifetime income and the contract value itself, the underlying contract value. You see, most annuities have 2 separate values. One is the investment value and one is the income value. Oftentimes, the income value can grow to be more than the contract value. And so when you say, hey, I want the contract value, you're going to walk away from this income value. Well, if this income value is greater than the contract value, it may be worthwhile of you keeping the contract because you're going to get more income than you could if you just took the contract value. So make sure that you understand the income value and the contract value before surrendering an annuity. The third question that you want to consider is there a death benefit available? A death benefit is typically an additional rider on an annuity, and this is a guarantee to receive some sort of value from the contract if someone dies. Now, that death benefit can be very significant if the owner of the annuity is no longer insurable. So if I'm not healthy enough or I'm too old to go out and buy life insurance, then I may want to consider holding on to my annuity before surrendering it, because that life insurance may be of great value for my spouse and for my family. Often this becomes an option when folks are uninsurable and the value that their family would receive after they're gone is greater than what they would receive if they were to surrender the contract. So the easiest way to look at this is through your financial plan and going through an estate scenario just to see what the ending value may look like. The next question to consider before surrendering an annuity is there a surrender charge? A surrender charge is the cost to get your money back from that contract. When you purchase an annuity, you're purchasing a guarantee of some sort. And if you pull the money out of that contract, you're canceling that contract. And there's typically a fee associated with doing so. So if you cancel your contract, the fee could be as high as 10%, just depending on the state that you're in. Now, that fee is going to be deducted from the contract value itself. And it could diminish over time depending on the type of contract that you have. So often we'll see surrender charges that are for 7 years, meaning that if you pull your money out of that contract from the date that you bought it 7 years forward, then you'll pay some sort of surrender penalty for doing so. And the value of that penalty is typically decreasing. So in year 1 year after you just bought your annuity contract, if you go to pull the money out in this scenario, you may pay 7%. In year 2, it might be 7% as well. And then in year 3, it might be 6, drop down to 5, 4, 3, 2. So depending on the surrender charge of the contract, that may be worthwhile for you timing out when you surrender that annuity. Now, the most important question that you should answer before surrendering an annuity is, what are the tax consequences involved? When you put money into an annuity, you're going to get tax deferral. And oftentimes people will put money into an annuity just to get the associated tax deferral. But when they cancel that annuity contract, now all of that money could be taxable. So you want to be aware of that up front. The other thing that you should work with a specialist on is knowing if you purchased multiple contracts in the same year, the IRS may treat that as a single transaction. And so if you give up annuity A and you're going to leave annuity B alone, you may have to pay taxes on both annuities, even though you're only getting the funds for annuity A. What's even more difficult is that you may have to pay capital gains taxes on both using only the funds from annuity A. So you want to be aware of these type of rules before surrendering a contract, because it could end up costing you a lot of money, costing you additional taxes, and it may not make it worthwhile for you to surrender that contract. So annuities can be very powerful for you in retirement, from providing income to decreasing your portfolio volatility to just having a consistent source of guaranteed income that you can depend on. But I've also seen people put way too much money into an annuity, also to see those annuities investments be mismanaged, and for them to not put the right riders on the contracts to make them really worthwhile. So each situation is going to be different. That's why you should speak with a licensed financial advisor to help you out, and also do a financial plan that shows you what your retirement income looks like with and without the annuity, and make sure that you add in the fees, including the mortality and expense and the sub-account fees if there are any. That way you're making an educated decision based on real data, and you can always go back to that financial plan and that model year after year. Thanks for watching. If you have any questions, I'd love to hear them.